This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Example 11. Like I say, an extract from a question, but exactly the sort of way you'd have it, and somewhere around 8 marks or so. But our job is, what discount rate should we use? Well, the first rule is this. Now, I'll give you a rule, but at the same time, I'm afraid I hate just giving rules. See a bit of logic, if for no other reason than any writtens that go with it. Yeah? Hello? Part A says we're going to finance this project entirely from equity. Entirely from equity. Now please, I know it's bad if I talk and talk and talk, but just listen for a second. Our shareholders have already invested money in the company and presumably are happy with the return they're getting. Too bad if they're not. It's happened, you know. But what we're thinking of doing is raising another, I don't know if it says the amount, but let's say 1 million. Does it say the amount? No, it doesn't. Let's say this new project is costing 1 million, all right? We're thinking of raising 1 million from shareholders and investing in the new project. All right? We assume our shareholders are well diversified. We're a big company. We assume later that's one of the reservations. They might not be. But we assume our shareholders are well diversified. And we say, well, if the shareholders were investing the money themselves in this project, all they'd care about is the risk of that project. You know, if you're investing 1 million yourself in a share, all that matters is the risk of the share. If it's more risky, you want a high return. If it's less risky, you want a low return. Well, you'll accept a low return. You agree? Well, even though here it's the company who's doing the investing, it's shareholders' money the company's investing on their behalf. And so we say, well, what return do we need to get shareholders? Well, if they were doing it, all they'd care about is how risky is this investment, what return do we need? And the company does the same. The company says, all that matters, forget the existing money is already invested, whatever, but this extra 1 million they're having to put in, the return we need from the project depends on how risky that project is. You understand me? And so if the project's got a beta of 1.8 or something, we can work out what return we'll need. And we'll discount at that return. And so if it's entirely from equity, the required return depends on the beta, the riskiness of the project. As simple as that. Now, it's always hard for me to keep repeating, doesn't gain anything. If I'm not making sense, you must shout. But what I'm getting at is it tells us X is an oil company. Shares in X have a beta of 1.48. Well, that's all very interesting. But the point is, this new investment, we're thinking of building ships. And if shareholders were investing in a ship company, all they'd care about is how risky are ships, if you're with me. We're doing it on their behalf. So we simply have to say, well, what's the risk? What's the beta of ships? And if the beta of ships is 2 or the beta of ships is 0.5, well, it's the risk of ships that determines the return we need to get for the shareholders. Is that clear? So that's what we need. In this case, the beta of shipbuilding. I don't care about oil. You know, that's already happening. I need to know the beta of shipbuilding, the new project. How can I find out the riskiness of shipbuilding? Well, this isn't just exams, it's real life. How on earth do you know the beta of building ships? You find a shipbuilding company. And you say, well, what's the beta of the shipbuilding company? If it's got a beta of 2, well, presumably that's the beta of building ships. Clear? And so to get the beta, you find a similar quoted company. Well, we've done that. It says here, we've found a quoted shipbuilding company Y, and shares in Y, if you jump a bit, have a beta of 1.8. All right? However, of course, we've got the problem we were dealing with before break. We are told the beta of a share is 1.8. Well, of course, part of the reason it's so high is because there's gearing. The beta of ships, we need to ungear the beta. You all agree with me? And so we're simply using the formula we had before. The share beta, or beta equity, is 1.8. We need to ungear. I hope very obviously, but make sure it is clear, all of you tell me. We're going to ungear using that formula, you know, market values. Which gearing ratio are we going to use to ungear it? There's 2 gearing ratios given you there. 0.2. Say again.
0.2.
Yeah, surely it's Y shares where we're trying to ungear. It's the gearing of Y that we'll use. Does that make sense? And so, Y, let's do it. I'll do this bit, you can do the next bit later. But I said I always write down the gearing. Equity debt. How's it defined here? Again, it's debt to equity. So for company Y, if the equity were 100, the debt is 20. All right? So, let's ungear it to find the risk of ships. It's beta asset we want. I won't write the whole formula down. But market value equity is 100 over equity plus debt times. The tax rate here, note, is 25%. So 1 minus T is 0.75, true? Times the equity beta, 1.8. Which gives me an asset beta, the one I'm after. Is it 1 point? And I'm going to work here throughout, and I would in the exam, to 2 decimal places. So I'm not worried about bits of rounding. Is it to 2 decimal places? 1.57. All right? Well, there is the risk of building ships. I'm asking shareholders to put their money in something with a risk of 1.57. If they were investing, what would their required return be? Well, the ordinary beta formula. Risk-free, 8%, plus beta times the market's premium, which is what? 18 minus 8. We need a return of, I think, 23.7. I think my arithmetic's right. Are we clear? And of course, how could we check whether it was giving a high enough return? Surely the way you'd check, and the question would have a lot more in it, but the lot more would be all the cash flows. Surely the way you'd check if it was giving 23.7 is you'd simply discount the cash flows at 23.7%. Does that make sense? And then you're back to basic F9, set up your cash flows, use your discount tables. Don't panic here. I've already said you'll always do it to the nearest percent, so you show your workings properly, you do it at 24. In fact, you'd never end up with 24 because you only get tables up to 20. So don't worry. But doing this, you might end up with 18.7. You'd just discount at 19% using your tables. Okay? So you're all happy there? And I hope it makes sense. I've written the rule down, but I hope it makes sense. It's not just learning. All right, well, if it makes sense, I think that is easy enough. I think that's quite nice for 8 marks. I really do. There's not a lot involved. But what about B? Now, again, you won't get A, B, C. You'll just pick one of these. But something like B is more likely. Where it's exactly the same project. So, again, you'd set up your cash flows as normal. But this time, the money's coming partly from equity and partly from debt. All right? Now, again, forgive me, but I will write the rule down. But just listen for a minute. I think you all remember from before that money from debt is likely to be cheaper. The cost of debt borrowing. Debt's less risky, so you need to pay a lower return. Debt gets tax relief. Yeah? So this time, half our money for the project is coming from cheap debt, on which we need a lower return. Half the money is coming from shareholders. Well, we've said for the risk they will want 23.7, but if only half the money is coming from equity and half's coming from debt, there's more gearing. Yeah? Hello? There's more gearing coming in. And so shareholders are actually going to want a bit more. You understand me? Because it's made it more risky. And so what's going to end up happening, we're borrowing, let's say, $1 million for this project. Half's coming from equity. And I'm inventing a figure here. They would have wanted 23.7, but because there's more gearing, maybe they want 25, let's say. Half of it's coming from debt, and we'll work out the figure in a minute, but that's going to be a lot cheaper. And we need to work out what overall return do we need to keep everybody happy. Well, what we do is this. We treat the project as though it's a little company. That's my words. But because money's coming part equity, part debt, we calculate a weighted average cost of capital for the project. So just like before, we ignore the company as it is at the moment. That's all done, we're all happy. But we say, here's this project. Imagine, I don't care how much it is, but let's say it's costing $1 million. This $1 million is coming part equity, part debt. Let's work out a weighted average for the project. Okay? So we'll work out cost of equity, cost of debt, and we'll take a weighted average, just like this morning. But our first little problem, for the cost of equity, clearly this question's got betas in. And of course, beta, depending on the riskiness, tells us the required return. All right? Yep. Hello? Well, our problem, surely, we knew if it was all equity, the project risk is, what was it, 1.57. So if you'd used all equity finance, there's the riskiness of the project. We're now saying we're doing the same project, same risk, but it's like a little geared project. Part of the money's coming from debt, which makes shareholders more risky. All right? And so we're going to have to work backwards effectively. We say if there's no gearing, it'll be 1.57. But because the project's geared, the risk to shareholders is a bit more. The beta will be a bit higher. All right? So we need to calculate the beta for equity. Now, as I keep saying, I'll try not to keep pausing, but do please shout if you lose me. Don't just learn a rule. There's the danger you'll forget in the middle of an exam. All right? Well, how are we going to do it? We've got that formula, have we not? That the asset beta is VE over VE plus VD1 minus T times beta E. That formula relates the two. This time, we know what the beta is with no gearing. We worked it out. If there was no gearing, the risk is, was it 1.57 again? Check me. I want to work out what the beta is for a shareholder and there is gearing. Tell me, what level of gearing am I going to use in this formula?
50-50?
It's 50-50. We're looking at the way we're financing the project. The project is financed 50% equity, 50% debt in Part B. We use here the gearing of the project. We're treating the project as a little company all by itself. The project in Part B is geared 50%, 50%. All right? Sensible, Natalia? And now, of course, it's back to formula work. But again, clearly, be very careful what you're putting where. This time we know beta asset, the ungeared beta is 1.57. The gearing we're using is the project. Well, it's equity 50, debt 50. You know, it's the ratio we're going to need. And so, VE, equity 50 over equity plus debt times 1 minus T. Times the equity beta. Well, that's what we're after. So again, as long as you are clear what figures I'm putting in, it's then, I think you'd agree, relatively simple calculator work. Well, will somebody check me? I get beta equity to be again, if I keep to 2 decimal places, I get 2.75. Everybody? Is that sensible? You know, always stop and pause. I said before, you may think I'm being silly, but you know as well as I do, in the middle of an exam, I don't care how well you know things, you press the wrong buttons and do silly things. But is it sensible? Surely it is, because using debt for the project has made it more risky for the shareholders. Here we're measuring the risk for the shareholders. You would expect the risk for the shareholders to be higher. Their beta is higher. All right? And so what return will shareholders want now? The shareholders' required return normal formula, risk-free plus beta times the premium. The risk-free is 8, beta 2.75. The market's giving 18 as against 8. Oh dear, it's enormous, but still. Am I right? 35.5%. And again, I'm not surprised it's higher. Shareholders, the return they want, partly depends on the risk of the project, but it's higher here because there's more gearing coming in. All right? And of course, if shareholders want 35, the company will have to get 35. There is the cost of equity for this project. However, they only need to get a return of 35.5 on half the money, because only half the money came from shareholders. The rest of the money came from debt. And to keep debt lenders happy, well, what's the cost of debt? What return do we need there? So the cost of debt well, I'm afraid it could be millions of things. Sorry, that's making it sound ridiculous. He could give you information in various ways. He could give you a thing like this morning and say with 10% redeemable debentures in 5 years' time, you know, internal rate of return. Here he hasn't, and very likely he won't. In which case we're going to have to make an assumption. Anybody, any suggestions? What are we going to have to assume in order to get a cost of debt?
8%?
Well, I know what you're meaning. The figure's wrong, but the assumption's right. If you're not given more information, we've no choice but to assume it's risk-free. I think you'd agree, we've no choice at all here. The only thing to watch though and be careful about, and this is where you're wrong, if we assume debt's risk-free, it's beta is 0, agreed? What return would investors want from something risk-free? What return would they require? No tricks. No tricks. Honest. Say again? Well, 8%, yeah? The point is the investors would want 8%. The company will have to give them 8%. But remember, debt interest is tax allowable. All right? So although the investor wants 8% and the company will pay them 8%, well, I will write down, even though the first line is irrelevant, investors require 8%. However, what I need to know is what will it cost the company? Surely the cost of debt, you assume there's tax relief, obviously. And so, with tax relief at 25%, it's costing the company 75%. The actual cost is 6. All right? So it's a tiny point, but obviously it makes a big difference. Yeah. And be careful, it's a very, very common error, you know. But whatever. Finally, though, we're saying for this project to be worthwhile, the project has to generate enough to give shareholders 35 and to give the debt people 6. Well, overall, what does it need to generate? The weighted average cost of capital. So the weighted average cost of capital for the project, it's normal workings, but it's for the project. The cost of equity we just worked out is 35.5. The cost of debt is 6. How is the project geared? It was 50%, 50%. And so the weighted average, exactly normal workings. You better check, but I think it's 20.75. All right. And how do you check it's giving 20.75? The way you check whether it's giving that return or not is surely you would discount the project. Well, in the exam, do the nearest percent, 21, but again, it will be a percent that's in the tables. All right? So I don't know, I hope you agree, it's not arithmetically hard, yeah? But you have to be clear what you're doing. You know, appreciate at the moment, the existing beta of our company is irrelevant, completely irrelevant. You know, currently we're oil, we're investing in ships. I don't care what the beta of oil is. You agree? The existing gearing of the company, completely irrelevant. All I care about is this, what return does this project need to generate? It's a weighted average for the project. Sensible? And finally, rather, all right, it's a bit of a throwback. I can't teach everything at once. But I think you should probably remember, doesn't affect the numbers are right. But something I'm going to mention after, a bit more than last time, but Modigliani and Miller, they were people who talked about gearing, and they said that the more gearing you had, the lower your weighted average would be. Don't worry if you have forgotten, but the lower the weighted average would be, because the real benefit, gearing gets tax relief. Debt gets tax relief, which makes it attractive. Now, if you've forgotten that, I'll remind you shortly, because there's a bit more to come on that. But you're not surprised, in fact, because this formula, in fact, comes from Modigliani and Miller. But you're not surprised if it's all equity, we need 35. If it's geared, sorry, I went wrong there, I beg your pardon. If it was all equity, we needed, what was it? 23.7, I'm sorry. 23.7. If we're gearing it, then although shareholders want a lot more, 35, because you've got all the very cheap debt at only 6 because of tax relief, the overall cost ends up being lower. Okay? Now, all right, if at the moment I don't really care, numbers are numbers, but you would expect the cost overall to be cheaper. All right, well, that's really it. Would you agree, please, without me wasting your time, would you agree that I could now give you anything? I could say, same project, but let's suppose it's, 60% equity, 40% debt. Or 10% equity, 90% debt. You agree, I could give you anything. You know, the beta of the project. You'd work out the beta of equity in the project, using whatever the gearing was. Hello? Beta of any debt, risk of any debt, cost of any debt, stays at 6. You'd work out a weighted average using whatever the gearing was, so you could do it for anything. I've put C in, though, because that has been asked quite a few times. Instead of saying, can you do it at 60%, 40%, or 20%, 80%, and so on, this time I've said it's the same project. We're going to use debt and equity, but we're going to raise it in the same ratio as that currently existing in the company. So there's no reason we should. but it has been quite common that if the current ratio is 20/80, let's say, that you raise the new money 20/80 as well. All right, I'll start it, you finish it. Part C, the steps always, you work out the beta of the project and we've done it. Whatever happens, whatever we do rather, the beta of the shipbuilding, it was the beta asset and it was, can somebody tell me, I've forgotten, what was the beta of ships? 1.57. Everybody? That, though, remember, is the asset beta. We need cost of equity, cost of debt, weighted average, as before. For cost of equity, we need the equity beta. Sorry, just let me write 2 lines, and then I will shut up. To work out the equity beta, you'll use the gearing in the project always. But in part C, what's the gearing ratio for the project going to be? Part B, it was 50%, 50%. What is it for part B? For part C?
24.
Say slowly.
40 to 100.
Yes, sorry, it was the Lithuanian. Yeah. It says it's the same ratio as currently exists in X. Well, X has a gearing ratio debt to equity of 0.4. But although it's always the gearing of the project, if it is the same as before, well, equity 100, debt 40. You agree? Can you finish it, please? Check as you go along by all means, but what is the beta of equity? What is the cost of equity? Cost of debt, weighted average. The project beta, 1.57. There's gearing in the project. So the share, the equity beta, gear up, use the formula backwards, using the gearing in the project. It's higher as you'd expect at 2.04. The return shareholders require, therefore, on their money, and the cost of equity, therefore. Normal formula 28.4. Cost of any debt here, the same, I hope clearly. We've assumed risk-free, there's nothing else we could do. I say again, if he'd given you all information about redeemable in 5 years and things, you'd have had to spend the time doing IRR. You agree, Katerina? Yes, you do. And it would take a few minutes longer, if it was IRR. Now, the weighted average, though, weight by the gearing of the project. And here, 22. Again, I could have had a better example. We're outside the tables, but I've dealt with that. In this case, you'd appraise at 22%. Okay? Now, I think you've all got it. I don't think that's bad. But it's the big extra problem that you're going to get, almost certainly in P4. I said at the very beginning, one of the two compulsory almost certainly will be a big MPV. A lot of the marks will be cash flow marks, Alright? But you will need to calculate the discount rate. And it's very, very, very likely it'd be something like that. If he'd said nothing at all, if he'd simply said, we're doing a new project, these cash flows, then you'd have had no choice. You'd have used the weighted average cost of the company. But I said before, that's only valid if you're not changing risk, if you're not changing gearing. Almost certainly, the risk will be different as it was here. Find a similar company and gear. Almost certainly, the gearing will be different. All right, it wasn't in Part C, Almost certainly, the gearing will be different. Even if the gearing is the same, you still need to do a weighted average for the project. Then it becomes normal discounting. From then on, there's sort of nothing new. Okay? However, although I think we've got that, and that is common, exam point of view, there is an alternative way of approaching because of one big problem. Or perhaps it may not sound very big. But that gearing and ungearing formula comes from Modigliani and Miller, who you may have forgotten me mentioning before, but I'm going to mention again in a few minutes. But it was Modigliani and Miller who did a lot of work on the effect of gearing. Okay? I'll remind you what conclusions they came to shortly. But they did lots of work on gearing, and it was them who came up with formulae to explain what the effect of gearing was. Now, what's not your problem is that, in fact, although capital asset itself is a separate theory, the gearing and ungearing formula actually comes from Modigliani and Miller. All right? Now, that doesn't really matter. The formula's there, you use it. But Modigliani and Miller, when they came up with formula, they made various assumptions. And although I'm not going to go through all of them, we don't need them, one big assumption they made was this. The formula assumes that any debt borrowing is irredeemable. In case you've forgotten the word, irredeemable means never repayable. So you borrow, you pay 8% or whatever a year forever. The debt never needs repaying. All right? Clear? Okay, obviously proving formula is irrelevant. You just use what you're given. But it does create a little problem. Now, in one sense, you can get around it and say, all right, in real life, of course, that's impossible. In real life, you can't borrow irredeemable. You'll always have to repay. Would you agree? And we can say, well, it's not too big a problem because, well, you could assume that, all right, you're borrowing money, you will repay. But if you assume that if you're repaying in 5 years, that you borrow more money to repay the existing, then in a sense, you can make it irredeemable. You with me? So, we generally don't worry too much. But even that, this idea that maybe you could make it irredeemable by keep replacing the borrowing, the trouble there is when you come to replace, interest rates might be different. You know. So, it's no big deal. I'm only saying that to explain why there is an alternative in a minute. But it is actually a sort of limitation of what we've done. And what I'm coming to shortly, you have to be patient with me, is because of that, he can ask you to deal with this in an alternative way. All right?